CONOCO's $30 billion 10-year plan. The oil company is paying out a buyback worth about half of its current market cap. Investors like the move. Tinder for solar and wind. How one company is trying to match buyers and sellers of alternative energy to cut down on time and money. Blockchain, meet asset manager, meet gold. I sit down with Danny Masters, co-principal at CoinShares, on how their attempt on a digital gold ETF will beat out the competition. I'm Alix Steele. Welcome to Bloomberg Commodities Edge. 30 minutes focused on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. First, we want to kick it off with Spot On. It's our reporter and investor take on the big story. And today, it's governments beating up on big oil. From the U.S. to the U.K., world leaders lash out against climate change.
It's a state of emergency, and I would declare a state of emergency on day one.
I think it is the existential threat to humanity. It's the number one issue.
What we have got to do tonight, and I will do as president, is to tell the fossil fuel industry that their short-term profits are not more important than the future of this planet.
The crisis demands swift action, but it isn't right to load the costs of the climate emergency onto the nurse, the builder, or the energy worker. So a Labour government will ensure the big oil and gas corporations that profit from heating up our planet will shoulder the burden and pay their fair share.
Joining me now is Bloomberg's managing editor for energy and commodities, Tina Davis. Tina, what's been your interpretation of sort of those running for election just beating down on big oil?
Well, it was interesting, the Democratic debate that you had, a clip from every single person on that stage either wants to ban fracking or limit it or regulate it more heavily in some way. So it is a very aggressive stance that we're seeing from the party that's trying to get the White House here in the United States. They're not the only people who are going after it. As you mentioned, we had Mr. CORBYN. We also had California this week. Governor Newsom put out some more regulations on fracking in that state. That's actually the 6th largest oil producer. So you're seeing a lot of attempts to kind of curb or rein in some of the production. And I think my colleagues at Bloomberg New Energy Finance have actually run the numbers on this, and they've come up with about 760,000 barrels a day in the Permian that could be constrained if we see a ban on fracking. And they're looking at the acreage that's in New Mexico, which is where a lot of the federal land is, about 2.5 million acres in the New Mexico side of the Permian would be at risk under some sort of fracking ban.
So there's sort of two storylines. Like, one is that you take a look at California and say, look, even if we don't ban fracking, there's some kind of restrictions that are coming down the pipeline. The stocks in California, like Berry Petroleum, got totally hit and wiped out on that news. The other is that, look, there's not that much oil really being produced on federal land. It's totally fine. We'll be fine. What are you hearing more of?
Well, I think people are still trying to wrap their heads around this. I mean, I think we've seen a lot of analyst notes. We've heard a lot of questions on earnings calls because there is concern in the industry about what this means. Alternatively, look, if you're going to impose some sort of ban, some sort of federal regulation, what it could actually do is impose the kind of restraints that the market itself hasn't been able to do on shale production in the U.S., certainly, and you could actually see a price rise as a result.
All right. Thank you so much, Bloomberg's Tina Davis. And for more on how to invest in this particular climate is Dan Pickering, founder and CIO of Pickering Energy Partners. He comes to us from Houston. Hey, Dan, what do you do as an investor? And you have world leaders and states restricting or wanting to ban big oil. What do you do with that?
Yeah, I think that's today's current environment is everybody's beating up on the sector. More regulation, more apathy around the sector. It's made stocks cheap. So you sort of sift through the ashes and trying to find good value.
Have you been able to find any good value with all these headlines?
Well, I think the whole space is probably reflecting longer-term prices than we'll actually see. Space is reflecting something in the 40s. We think that something in the 50s or 60s is much more likely. So the whole space looks cheap. You know, we're going to talk about CONOCO. That's a name that looks cheap with a lot of free cash here. I think the industry is adapting to a lower commodity price environment. That's really important, and discipline's coming back to the space. And so there's just a lot of opportunity out there generally.
Before we specifically move to CONOCO, I mean, would your sort of lens be focused on a company like CONOCO or a more specialized company that then could have more exposure if there are restrictions on fracking or there's a fracking ban? Which do you feel like proposes more value for you?
Yeah, I think a fracking ban isn't particularly realistic, Alex. The challenge is it sounds great until you think about the implications. The folks that want to ban fracking also want low-cost energy and low gasoline prices, and you're not going to have that if you start taking drilling opportunities off the table. So prices go into the 70s, 80s, 90s if you ban fracking, and so, you know, I wouldn't necessarily focus on companies that benefit from that because I don't think it's going to happen. I'd really be more focused on the blocking and tackling producers.
All right, so let's get to the blocking and tackling producers, and part of that's CONOCO. They had their 10-year plan unleashed today. Huge return for shareholders, buybacks, dividends. What was your biggest takeaway here on their plan?
Yeah, I think my biggest takeaway was they are adopting to the world that we are in, not hopeful for something to improve, and so they're kind of $50 billion 10-year plan says oil's at 50 for that whole time period. And they've adopted a kind of a low cost of supply model that makes money in that environment. And so I think that's where the whole industry is going. CONOCO's got a great asset base that they can kind of live in this world and make great money. And again, that comes back to the value in the space. This company can buy back half of their market cap over the next 10 years. With oil prices at the current level. They've adopted to the world we're in. And
that's a staggering, like half of its market cap. You echo very similar things to Liam Denning, who's a columnist here at Bloomberg. He said, CONOCO's message is that just ensuring that you don't spend more than you make in a given year isn't the cure for the sector's ills. Rather, it's about smoothing spending, production, and payouts over time. Who else is onto this?
Yeah, I think most of the industry is moving this direction, whether it's the independent E&P companies out in the Permian, the big majors. Everyone's essentially said we can't count on prices being higher. And so they've adopted drilling in locations that make money where oil's 50. They've adopted, they're selling non-core properties where they think the operating costs are too high. And so I think it's the whole industry. Some of the smaller companies are still focused on growth, but for the most part, most of the market cap in the space is thinking about capital discipline, better returns, dividends, share repurchase, and that's what's going to bring investors back to the space eventually.
So you mentioned CONOCO. Who else would you like right now?
We like the Permian producers, EOG Resources, Diamondback Energy, Concho, Parsley, folks with great positions in low-cost basins. Again, those stocks are all underperforming the S&P, and many are underperforming their peers for the year. But those are names where we think the cost of the resource is very attractive, and investors will eventually come back.
Dan, super great to catch up with you. Thank you very much. Dan Pickering of Pickering Energy Partners. And governments aren't the only ones beating up on big oil. So's Saudi Aramco. Its CFO calls companies like Shell and Exxon a dying breed and says Aramco is actually different. Well, Brian Gilvari is the CFO of BP, and he weighed in on the state of big oil.
We are a significant energy company, and a significant mix of what we do comes from oil and gas. And what you've seen in the recent period beyond 2014 is a shift towards gas. You're seeing a little bit of a pivot back towards more oil projects, which typically have higher returns. The issue for companies like BP is how do we deal with the CO2 that comes with that oil and gas, and how we actually offset that in some way going forward.
I'm Alix. This is Bloomberg Commodities Edge. It's time now for the Data Dig, where we delve deep into the market trends of the week. First up, oil inventories. They rose just 1.4 million barrels. But the bullish part of the data was we had almost 2 million barrels were released from the SPR. So that build that we saw was actually less than the draw. And it's a bearish mood sweeping through the nickel market. Prices there down by about 20% from its highs. However, we could be stabilizing here. Citi actually calling for a snapback next year as tighter conditions start to reemerge. And do you want to make some more money? God bless Midland, because it turns out everything is bigger in Texas, including paychecks. Check this out. New data from the Commerce Department shows that pay is growing the fastest in oil boom towns of Odessa and Midland, Texas. Per capita, you're looking at about $122,000. Those figures top per capita income in New York City, San Francisco, and Boston. All right, now I want to get into the ring with the disruptive revolution in utilities. So the latest casualty could actually be National Grid. In a few days, New York Governor Andrew Cuomo has to decide whether or not he will kick the utility out of New York State after National Grid refused to send more gas to customers and Cuomo refused to let them build a pipeline. Joining us now with more is Elta Colo, research manager for the Grid Edge team at Wood Mackenzie. Elta, thanks for joining.
Thanks for having me on, Alex.
So what's happening? This is so strange and so unprecedented that you might have a governor kick a utility out of a state.
Right. First of all, I don't think it's going to happen, right? I think National Grid is going to come back with a set of solutions, right? They've done this before on the wire side, and I think they're going to do the same thing on the pipe side. I think the interesting thing that you're seeing here that's taking place in New York is this broader disconnect of meeting short-term energy needs and wanting to meet those long-term emissions targets, right, that the state has set and both the city as well.
So meaning basically that they wanted to build a gas pipeline, but Cuomo said no because he wants eventually for us to use less gas and more alternative energy. But then at the same time, our customers today still need the gas.
Exactly.
That's an impossible solution.
You can come up with short-term solutions, right? Even if you were to build out the pipeline, say you started construction tomorrow, it would honestly be about a year before you could service customers. So even in the interim, you'd have to come up with solutions for this winter, right? And I think the way that this is going to go is National Grid is going to come back and they're going to come with demand response type solutions, right? They're going to ask their large users to essentially respond to price and be able to reroute some of that demand.
But this also is in stark contrast to say what's happening with PG&E in that the overwhelming conversation is the utility model getting disrupted and causing a lot of problems.
Right.
Obviously, PG&E has its own idiosyncratic issues with the wildfires in California, but how does something like that play out in the medium term?
Right, so in the medium term, I think short term and medium term, all eyes are on utilities, right? We want to meet these emissions targets that are extremely aggressive across states. And you want to do it with renewables and you want to do it with decarbonizing buildings, right? And the utilities are at the heart of this. They have to put the poles and wires in place. They have to interconnect all of these renewables and they have to do it reliably and they have to do it safely, right? And at the end of the day, they have to service customers at the lowest possible cost. So they have to bring in innovative business models to be able to do that. And now you're layering on this climate risk on top of it, which is, playing out right now with PG&E.
Do you feel like the answer is state or local areas sort of nationalizing the pipes, nationalizing transmission wires? Like, is that the solution?
I'm not so sure, right? So you're seeing a broader trend that's taking place right now. We have about 25 utilities across the country, investor-owned utilities, that have set targets for themselves to meet, 80 to 100% either carbon-free targets or provide electricity from renewables. And essentially what that's saying is they're having this longer-term outlook. Before regulators come to them saying you need to do this, they're planning for themselves for the future.
All right, Elta, thank you so much. I appreciate it. Elta Colo, research manager at Wood Mackenzie. It's time now for our note of the week, and it comes to us from Citi's Anthony Yuen, who's floating the idea of a gas group just like OPEC. He says the 2024 period and beyond should be crunch time for global gas suppliers. With forming a gas OPEC a tantalizing possibility, global gas exporters might find forming a gas OPEC convenient by limiting gas exports to boost prices. And energy and climate change were some main issues at Bloomberg's new economy forum in Beijing.
And then no water, no beer. That's simple. So sustainability for us is our business. It's not just a part, an add-on. It's central to our business.
In terms of climate change, we can say that China always sticks to the principle of multilateralism. In Copenhagen, because of different opinions, especially between China and the US, because of lack of coordination. So ultimately, we only achieved a limited agreement, but this was not binding. But after that, China and US stepped up cooperation.
People have sort of gotten excited about the low-hanging fruit. Electric cars, that's the easy part. You still have to do the grid, but the various things, including industrial, are very, very difficult.
I'm Alix Steele. This is Bloomberg Commodities Edge. Time now for BNEF Brief, which gives in-depth analysis on clean energy, advanced transport, commodities, and emerging technologies. And today we look at Tinder for solar and wind. BNEF data shows that companies have signed contracts to buy a record 15.5 gigawatts of clean energy. That's 14% more than all of last year. And those still looking for the right supplier, well, now there's an app for that. Here to explain it, Skylar Harrison from Bloomberg NEF. It's not really an app, but like the idea is that it's making it easier to find these production contracts.
Exactly. I mean, it effectively functions as an online marketplace where clean energy suppliers can advertise their projects, and then a corporate customer that wants to buy clean energy can go ahead and specify criteria like where can I buy clean energy, what technology do I need, and how much do I want to buy. And then the marketplace will actually go ahead and match them with a project based on that criteria.
Is there actually a market for that?
There definitely is. You now have this second generation of less experienced corporate clean energy buyers behind those Googles and Microsofts. And those companies need hand-holding through that process. They're not familiar and comfortable with a lot of the nuances that come with buying clean energy related to accounting and tax and legal and things like that. So having these brokers and these marketplaces to hold their hand through that process is a huge benefit to them.
And when you have something that immediate, maybe, I know it takes a couple of years, but an easier way to sort of hook up with people, do you have longer contracts? Are they shorter? Are you going to have more flexibility? How does that work?
Yeah, historically, those experienced buyers would sign 20 to 25-year clean energy deals. But you have this second wave again of less experienced buyers that have trouble convincing their CFO to write them a check for more than 5 years for a clean energy contract. So actually, over time, you've seen clean energy contracts get shorter and shorter. And one of the big drivers of that is these brokers, because they'll match suppliers that have a little bit more flexibility on term length with buyers who need it.
Is that a good or bad thing?
It's definitely a good thing. I mean, you need to meet somewhere in the middle. Clean energy suppliers need term length to go ahead and secure financing. But again, corporate buyers actually want to go ahead and sign shorter deals.
How hard is it to get these deals done?
I mean, it really varies and it depends on the market. The United States is a really experienced market for this, and you now have a blueprint for signing these contracts. And you have a lot of experienced brokers that'll, again, hold your hand. So there's companies like Schneider Electric and Edison Energy that have been doing this for years, and they'll really simplify the process.
See, maybe one day there will be an app for that. All right, Kyle Harrison of Bloomberg NEF, thanks very much. I appreciate it. All right, we turn now to Commodity in Chief, where we focus on one executive in the commodity world. And today it's Danny Masters from CoinShares. First, a closer look at the company. Here's another way to own gold, digitally. CoinShares, meet blockchain.com, meet MKS. What that really means, Europe's largest digital asset manager, meet a blockchain platform, meet a gold group. The result? DGLD, a digital token that represents gold stored in a Swiss vault that you can track on a Bitcoin network. Want to redeem it? Go ahead. You can get a 400-ounce LBMA bar from a vault in Switzerland and get it FedExed right to your door. If you don't have enough tokens, then you can swap them for smaller amounts of gold, like 1 gram for $50. The pitch is it's as easy as owning a gold ETF without all the middlemen of owning a gold ETF. DGLD will first be available exclusively on The Pit, a blockchain crypto exchange. And they aren't the only ones who've tried this. There have been over 30 other attempts to start a gold trading blockchain platform and get it right. CoinShares hopes it can be the one to strike gold. I recently caught up with Danny and I asked him what makes his product so different.
Many of the people that have attempted this in earlier times have not had the credibility within the gold community to do this. So they've self-custodied their gold, or they've used some third-party agent to custody the gold. We're using a gold partner through MKS and PAMP that is the world leader, and with whom a number of Swiss banks, billionaires and banks, keep their gold and have done for many, many years with that organization. So that, I think, is one barrier, and we're very proud to be working with that group. The second barrier is obviously the distribution. This is where the blockchain relationship is so important, and I think that when we look at the digital asset universe as it's beginning to emerge with real estate and bonds and commodities being tokenized, I believe it's actually the people with the largest wallet infrastructures that will win. It's a little bit like the Amazon of retail when you think about big wallet distribution like blockchain. It's the natural place where all digital assets should live.
How easy or hard is it to make a market?
Well, we're also engaging, as the ETF players do actually, we're also engaging with some of the world's best authorized participants, and those authorized participants will keep this marketplace arbitrage free. Authorized participants will be financial companies that have the ability to create tokens if there's demand, or indeed, if the token price starts to deviate downwards from the price of gold, to redeem those tokens for gold, thereby keeping it in line with the price of gold at all times.
Can you walk me through some of the other attempts that have happened and what you noticed didn't work and then how you tried to correct for it?
There's been some other credible attempts as well. The RMG project, which was backed by the Chicago Mercantile Exchange and the Royal Mint here in London, that failed also, but that was more to do with regulatory issues here in the UK around the construction of their particular situation they had. We solved for that by working with the Swiss regulators, who are frankly much more advanced than the regulators here in the UK and are much more supportive of the digital asset space. So being Swiss-based, I think, is a big advantage in that respect.
Do you just stop with gold? Do you diversify into other commodities as well and offer those products? And can you walk us through that?
Well, gold is particularly suited for digitization because in a lot of regulatory jurisdictions it's not a specified investment and therefore doesn't fall within the regulatory framework of many countries, making it almost like a currency and very freely exchangeable. But in terms of its physical characteristics, what we will look to do next is we'll look to tokenize further hard assets. I would imagine silver would be probably top of that list, and then we'll probably go through the other precious metals like platinum and palladium before turning our attention to base metals.
I was going to say, is there a market for some of the base metals that are just traded differently than the precious?
Well, we haven't really delved into that in great detail yet, but I think unlike gold, where allocated gold has a very particular position in the financial universe, obviously when you get into copper, aluminum, zinc, nickel, tin and so on in the base metal world, that concept of allocation isn't quite as strong and isn't quite as well trodden as in gold. But we think there might be more trading type applications for the technology and the tokenization in the base metal space than there is investment opportunity in the gold and silver space.
That was my interview with Danny Masters of CoinShares. And adding a Thanksgiving ham to your dinner this year is going to cost you an arm and a hock. Prices for holiday ham now skyrocketing to levels not seen since 2014. That's because the African swine fever, the epidemic sweeping through hog herds in Asia, the formidable supply gap is now forcing China to buy American meat. And those producers have to ship record numbers of whole hog carcasses to the Asian country. Now for us, U.S. consumers, you gotta stop swining. The American market's been mostly insulated from the impact until recently. In fact, most of this year's gains in ham prices have come just in the past few weeks, just in time for your holiday dinner. And speaking of Thanksgiving, next Thursday we are off due to the holiday here in the U.S. Have a happy Turkey Day, everyone. You can watch us other Thursdays at 1 p.m. Eastern Time in New York. This is Bloomberg.